Right, before the break we were talking about the hedging of exposures using interest rate futures, using T-bill futures to be more precise. Let us look at how the T-bill futures lock in the forward rate. When I take a position in a T-bill future, let us say I take a long position in a T-bill future, say at time t equal to 0, I take a long position in a T-bill future. What does it mean? It means that I will receive a T-bill at this point capital T and I will pay a certain price f0 t n. f0 t n I will pay a price at this point. At this point I will pay a certain price f0 t n, and this price f0 t n, the important part is the price f0 t n is determined at t equal to 0. Therefore, my cash outflow at t equal to capital T is determined at t equal to 0. And because I have the T bill now with me, and at t equal to capital N, which is the maturity of the T bill, that is the underlying instrument of the future that I have received under the future long position of the futures contract, I will receive the face value of the T bill when the T bill matures, which is again known and determined at t equal to 0. Therefore, both the cash flows that are going to occur, number 1, which is going to occur at t equal to capital T, and number 2, which is going to occur at t equal to capital N, are known at t equal to 0. Both the cash flows are fully determined, no stochasticity, they are known, of course, subject to MTM requirements, but they are otherwise fully known. And that being the case, because I know this outflow, I know this inflow, I know the interest rate, discount rate, or the return that holds between t and n. In other words, I have fixed the forward rate, and when do I know it? I know it at t equal to 0. Therefore, at t equal to 0, I have fixed the forward rate that will apply for the period t equal to capital T to t equal to capital N. This is how a position in a T bill future enables us to fix the forward rate. Let us now look at a different scenario. How does it lock a spot rate? Let us say I have a T bill with me, it has a maturity of n or n star rather, it has a maturity of n star. Okay, so we are talking about the locking of a spot rate. We just discussed the locking of a forward rate. Let us now discuss the locking of a spot rate, how a position in a T bill futures enables us to lock a spot rate. Let us say I have a long position in a T bill, not T bill futures. I have a long position in a T bill futures at t equal to 0. I purchased a T bill from the market. I have paid a price p n star. N star is the maturity of the T bill, not futures, T bill. N star is the maturity of the T bill, and I have paid a certain price as per the market prevailing discount yields or interest rates. I have paid a certain price p n star, and I have acquired a long position. I have acquired a T bill from the market. At the same time, I have shorted a T bill future with delivery, entailing delivery at t equal to capital T. So, I have a portfolio consisting of a T bill which has a maturity of n star, for which I have paid a certain price, which is p n star, and I have taken a short position in a T bill future which entails delivery of a T bill. I will have to make the delivery because I have taken a short position and at capital T. Now, what happens at capital T? Because the futures will mature for delivery at capital T, and I have taken a short position, I will have to deliver a T bill. I will purchase from the market and I will deliver it at this particular point, for which I will get a certain price f0 t and n. And at the same time, because I have got that I have got money against delivery of the T bill, I will invest that money for t to n. The money, this amount of money that I have received against my short position of the T-bill. I have received the money and I have delivered the T-bill. I will invest this money at this point, right. So, now it remains, what is the situation now? The situation is that I have paid for the T-bill from the market, I have purchased the T-bill from the market, or in fact, I can also make delivery of this existing T-bill that I have. And the second thing is that I have received a certain amount of money and I have delivered this T-bill. The situation now is that this particular cash outflow is matched by an inflow at capital T. Both are known at t equal to 0. Both are known at t equal to 0. This amount is the actual amount that I have paid in the market. This amount is the short futures position, which is again determined at t equal to 0. Knowing these two, obviously I know the interest rate or the discount rate that prevails between 0 and capital T. So, that is how we can work out, or we can lock in a spot rate given a spot rate, a different spot rate, a spot rate with a different maturity and a forward rate. And I will take up an example later on, which will make this clear. Now, we talk about different situations which I illustrated in the earlier slides. Let us talk about different practical situations. You hold a 10 million 91-day T-bills which you will sell in 1 month's time, because you need to pay your creditors. Now, the point is these T-bills have still 3 months to go. So, your cash flow at 3 months to go, 3 months from now is determined. You will get the face value, but your investment horizon is lesser than that. Your investment horizon is only 1 month, and therefore, you are exposed to the risk that if the interest rates change during this period of 1 month, the price that you will receive from the market on liquidating this T-bill portfolio would be less than what you are expecting at this moment. So, what you do, because you are having a long position in this T-bills, you take a short position in T-bill futures, and thereby what will happen? If there is a rise in interest rates, as a result of which the price of your portfolio falls, that rise in interest rates will also be reflected in the price of the T-bill futures. Rise in interest rates will make the T-bill futures cheaper, and because you are having a short position in the T-bill futures, you will make a profit on the futures market or the futures position, which will compensate you for the loss that you make in the spot market. A similar situation arises when you in the second case, you expect to receive a certain amount of money, 10 million in 6 months, and which you want to invest in a euro-dollar deposit. Now, you want to make an investment in euro-dollar deposits. If the interest rates fall, then the income that you are going to get from the euro-dollar deposits is going to decrease. Therefore, if the interest rates fall, you are going to be adversely affected. Hence, the hedge should be such that if the interest rates fall, you should make a profit. In other words, you will take a long position in the T-bill futures. Why? Because if the interest rates fall, the prices of the T-bills will increase, and T-bill futures will also increase, and you will make a profit by taking a long position in T-bill futures. Another example of a borrowing similar to the previous one, you plan to issue a certain amount of money at a certain future date. You are worried that if the interest rates rise, then you may not get the amount of money that you expect, because the repayment is fixed. Let us say the repayment is fixed. If the interest rates rise, the money that you are going to receive by making the issue is going to be reduced, inversely related to the market yields. Higher the market yield, lower is your present value of the repayment. If repayment is fixed, the present value will decrease. Now, to compensate that, what would you do? You take a short position in the T-bill futures, because if interest rates rise, prices will go down, you will make a profit on the futures. Let us talk about the quantitative part now, and this is very interesting. Hedging an existing portfolio. You got an existing portfolio of T-bills, you want to hedge that against a risk of a change in interest rates. Now, this is the Fs is the face value of your portfolio, Fs is the face value of your portfolio, the investment's face value, and V0s is the value of that investment at t equal to 0. This is the discount yield prevailing in the market as of now at t equal to 0, and therefore, the present value of this or the current market price, you can say, of this particular investment face value that you are invested in is this amount, and this is the corresponding face value at a certain later point in time, which is your investment horizon. Let us say t equal to capital T. At t equal to capital T, this is the value of your investment. The face value obviously remains the same. The discount yield may have changed, and you want to protect yourself against a change in the discount yield. Now, the change between these two is given by this expression. It is quite clear. The first term Fs and Fs cancel out, and we have Fs into ds0 n upon 360. N. What is n? N is the life of the T-bill. N is not your investment horizon. N is the life of the T-bill. Please note this. N is this. This is the life of the T-bill. This is the point. This is your hedge period, the period for which you want to be hedged. This is your hedge period. This is maturity of bill. Okay. So, this is what we arrive at in terms of this particular expression. Now, please note this is n minus t because the remaining life is n minus t. Now, this can be written in this form by simply adding the expression this and subtracting the expression. This same expression is added and same expression is subtracted. And if you look at this, I can write it in this form. I take this expression common, that is this n minus t, and I write it as dst minus ds0 as this expression, and I am left with this particular expression. Now, this expression, if you look at it carefully, is nothing but the erosion in value of the amortization in value due to passage of time due to the original yield. If the original yield did not change, then even then this change would have occurred, this change in value would have occurred, because this change is due to the time value of money at the constant rate. Hence, we are not worried about this particular term. What we want to hedge is this particular term which arises due to change in the interest rate, change in the yields. Now, for the futures, as you know, futures can be written in this form. The price, the transaction price of a futures can be written in terms of the face value per futures contract is this. So, this is the price per future. Please note this. This is the price, this transaction price per future at t equal to 0, and this is the transaction price per future at t equal to capital T when we close out the hedge, when we lift the hedge. Therefore, the change in the futures is given by this expression, and if we have NF futures, it is multiplied by NF. So, this is the change in the futures position of NF futures. At the total futures position, the change in the value of the total futures position is given by this expression. If you simplify this, in fact, if you see, now let's look at it carefully. If you look at these two terms, the stochastic terms are this and this. The stochastic terms are this, the others are totally deterministic terms, they have no randomness in them. These two terms are random. These two terms are captured by the beta. These two terms are captured by the beta. The remaining terms remain as it is. In fact, if you work out this variance of the portfolio comprising of ds and df, and thereafter you try to optimize it, to minimize the variance, you end up with this expression, as we have done so many times. So, this is the optimal number of contracts that we require for hedging in the case of an existing T-bill portfolio. Please note, important thing is that this number of contracts is proportional to n minus t. A number of contracts NF is proportional to n minus t. What is n minus t? N minus t is the remaining life of the treasury bills or of the investment. Why n minus t is relevant? Because the change in yield is going to influence the portfolio over this remaining time. It is going to act on the face value of the bond or the price of the bond, so that of the T bills for this period of time. This period is already gone. So, it is going to influence the price on this. The longer this period is, the greater is going to be the impact on the price of a change in interest rate. The shorter this period is, if the change in price or the change in yield, change in yield is not going to significantly affect the price. The longer the period is, the longer is the impact of a change in price on the fixed income security. So, some observations. The entire stochasticity, I mentioned the entire stochasticity of yields is captured by beta. The other terms are totally deterministic. Now, it is very common in practice to assume that these yield shifts in the spot market and the future markets are parallel. In other words, the changes in yields are equal insofar as the spot markets and future markets are concerned. It follows that beta is, as a first approximation, as a simple approximation, taken as 1 for first order calculations. You may say that we assume that the two the spot yields and the futures yield move parallel to each other, and as a result, the shift that we have in the spot yield and the shift that we have in the futures yield are approximately equal. Whether it really happens or not would impact the effectiveness of the hedge, as we will see later. This I have already mentioned, that the futures position is proportional to the remaining time of the T-bill. Longer the remaining time, longer is the n minus t, longer is the or larger is the futures position that you need in order to protect yourself against that, because larger is going to be the impact of a given change in yields. Let us take an example. Today is t equal to 0. XYZ Limited is holding 364-day T-bills face value of 10 million with a maturity of 12 months, 364 days, that is. Its investment horizon is up to 2 months. The life of the bill is 12 months. The life of the T-bill is 12 months, but its investment horizon is, this is 12 months, but it wants to remain invested only up to 2 months. Thereafter, it will dispose the bills off in the market. The company decides to hedge to 3 month T-bill futures with delivery at t equal to 5 months. That means 3-month futures with delivery at t equal to 5 months. I have taken a futures position at this point. The futures are going to be delivered at t equal to 5 months, and of course, they will mature at t equal to 8 months. I repeat, the futures position is taken at t equal to 0. Now, please note one thing. When we talk about futures, T-bill futures or other interest rate futures, there are 2 time points. One is the time point that this is the point at which we take the position in the futures contract. This is t equal to 0. This is the time point at which the futures mature for delivery, and this is the time point at which the instrument matures for payment. Now, please note, the 3-month period is this period. This is 3 months. Between t and n is 3 months, not between 0 and t. 0 and t can be different. 0 and t need not necessarily be 3 months. Here it is 5 months. The delivery is after 5 months. But at 5 months, what I will get is a T-bill which matures in 3 months from 5 months, that is at t equal to 8 months. This is important. the hedge will be lifted at t equal to 2 months by closing of the futures contract. So, at this point you are going to lift the hedge at t equal to 2 months, you are going to lift the hedge. The futures were to be delivered at this point, sorry, the T-bills were to be delivered at this point, but you have closed out the hedge at this point. The IMM index quotes at t equal to 0 and t, this is what is relevant for us, because we opened our position at t equal to 0, we closed out our position at t equal to 2. So, the IM quotes that are relevant to us are at these two dates, which are 88.00 and 86.00. Spot discount yields on the T-bills at these two are 9% and 11%. Work out the extent to which the hedges operated successfully. Assume spot and future yield shifts to be parallel. Let us see how we work it out. The value of the portfolio is given as 10 million. The life of the T-bills is 12 months. Our holding period is 2 months. The remaining life is 10 months. The value of each futures contract is 1 million. So, how many contracts are there? Well, n minus t, beta is 1, please note this. So, n minus t into the value of the spot position, which is this one, divided by 3, that is 3 months, because we are taking it in 3 because we are taking it everything in terms of months. So, the futures have a maturity of 3 months. So, instead of 0.25, and that is when we talk about years. So, this 3 months comes into this place, and n minus t is also taken in terms of months. In other words, if you divide this by 12, this by 12, we get the same thing. If you divide this by 360 and multiply this by 30 and divide by 360, you still get the same thing. So, the units must be consistent, that is important. So, n minus t is 10 months. The value of this spot position or cash position is 10 million. The value per futures is 1 million, and when you simplify this, you get 33.3333 contracts, which is rounded off to 33 contracts. So, in other words, you require 33 contracts after rounding off. Actually, you require 33.33 contracts, but after rounding off to 33, this is what the basis risk is going to come to. And this 33 contracts is what you require for hedging. You take a short position in this. Why a short position? Because you want to hedge against a price fall in your original portfolio. Now, futures quotes are 88 and 86. The corresponding discount yield expressed as a fraction is 0.12 and 0.14. And when you work out the price, how do we work out the price? 1 million face value into 1 minus 0.25 into whatever is the yield. So, when you use this formula at 12, this comes to 0.03, and you multiply it, you get this, and similarly for this you get this. Now, because this is a short position, what happens? The profit will be not this minus this, not closing minus opening, but because it is a short position, it will be opening minus closing. In other words, you get a profit of 5,000. Because you are having 33 contracts, your total profit on the futures position comes out to 5,000 into 33, that is 165,000. Let us now look at the cash position. The cash position, the yield has changed from 9% to 11%. The maturity at t equal to 0 was 1 year, roughly 1 year, 364 days, and at t equal to 11%, it was 10 months, which was 0.83 of the year. Therefore, the price works out to 910,000, 908,333.33. This is the price at the end of the second month, when corresponding to a yield of 11%. Now, the most important thing is that out of this price of 9, you see this price of 9100 is at a yield of 9%, and this is to go up to 1 million at the end of 1 year from now at the same 9%. If the interest rates remain at 9%, this price will go up to 1 million at this basis. Now, at the second month, end of the second month, the price would have changed a little bit. Even if the return continues to be 9%, why? Because it cannot make a jump from 0.9 million to 1 million, 0.91 million to 1 million all of a sudden at the end of the maturity. It has to be a steady continuous growth from 0.91 million to 1 million. Therefore, when you liquidate it at t equal to 2 months, even if the yield had not changed, it had remained 9%, the price would have gone up by a certain amount. The price would have gone up to 925,000. This price would have been 925,000 at this point. However, the actual price has turned out, because the yields have changed, the market position has changed, the market interest rates have changed, the actual price has gone down. Instead of 925, it has now shown 908,333, 908,333. Therefore, the loss on the cash position is not this minus this. In fact, this is it is not this minus this, it is this minus this. See, it should have been this, but it is actually this. This is at 9%, this is at 11%, this is at 9% for 10 months, this is at 11% for 10 months. Therefore, the loss is this amount per T-bill, per million. So, for 10 millions it works out to this much amount. This is the total loss. This is not relevant because this was at an earlier date. So, if we use this expression, we are not considering time value of money due to the original yield, which is also to be considered, which is, you see, which was very much planned for, which was anticipated, which is not unanticipated. So, this is not an unanticipated change. You are already providing for 9% yield. So, that is what it is, and therefore, the profit is this much, the loss is this much, and you end up with a net loss of this much. Now, this loss, where does it come from? This loss comes from the fact that you have rounded off the contracts from 33.33 to 33. Had you taken 33.33 contracts, you would have ended up with a zero loss. Now, we talk about hedging of a future investment. We have talked about hedging of an existing portfolio. Now, let us talk about hedging of a future. You want to make an investment in the future, and you are worried about the change in value due to a change in interest rate. How will it affect your return on that investment? You want to make an investment in some fixed income asset, and you are worried about the change in interest rates. So, let the amount to be invested be this much at time t. Then, assuming that the yields remain unchanged, at today's level, at t equal to 0 level, then this would be the relevant equation. This is the face value of at the maturity of the investment, and this would be the current price or current value of the investment, and this would be the face value when you liquidate the investment on the maturity of the investment. Now, let us assume that, now please note, this is on the basis of the yield that is prevailing today, but you are actually going to make the investment at this point, and you are going to liquidate it at this point. You are making the investment at this, and you are liquidating the investment at this. So, when you make the investment at this, if the yields remain unchanged, this is the amount that you would have to provide for making the investment. Now, suppose the actual yield at this point, when you go for the investment, comes out to be this much. At this point, it was ds0. At this point, it turns out to be dst. Now, if DST turns out to be different from DS0, then the amount that you require for obtaining the same face value here would be naturally be different. Therefore, the change in the cash position, the loss that you are going to suffer, it could be a profit also, but the difference would be df this minus this, that is equal to, if you simplify this, you get this expression. Now, hence the change in value of the exposure due to the yield change, you anticipated DS0, it turned out to be DST. The change in the investment amount that you have made due to accommodating this yield change is given by this expression. For each futures, using the same notation as we had earlier, this is the change in the futures position. This is the number of contracts, this is the face value per futures contract, this is the change in the yield of the futures contracts. And when you simplify this, we again arrive at the same expression, which is given by NF is equal to N minus T. This expression, of course, there will be a negative sign if you want to highlight the long short relationship, then this minus sign will have to be there. Let us take an example. It is T equal to 0 and the treasurer of company X expects to receive $1 million in T equal to 3 months. He will receive $1 million at T equal to 3 months, which he will invest in a 6-month T-bill up to T equal to 9 months. This is 0. He will receive the money at 3 and he will invest it up to 9. The treasurer fears a fall in interest rates. If interest rate falls, naturally his return on this investment is likely to fall. So, what does he do? He goes long in 3-month T-bill futures at this point. Now, by going long at this point in T-bill futures, what does he do? If there is an increase in the price of T-bills or T-bill futures, he will make a profit. In other words, if interest rates go down, the loss that he will make on the cash position on the investment will be compensated by the profit that he makes on the futures position. The treasurer fears the fall in interest rates, which would imply that his investment beginning in T equal to 3 months will earn less interest. The treasurer goes long 3-month T-bill futures today with maturity at T equal to 4 months. The IM index quotes at T equal to 0 and T equal to 3. This is when this is going to be locked in, when the hedge is to be lifted, when the position is to be closed, of the T-bill futures turn out to be 89.2 and 90.3 respectively. Spot investment rates at T equal to 0 and T equal to 3 months are 11% and 9 points. Work out the extent to which the hedge is. Okay. So, value of the investment is 1 million and the life of the investment is 6 months starting 3 months from now. Now, let us see how many contracts are required. N minus T is 6 months. This QS is 1 million, F is also 1 million and this is 3 months. This is 6 months, this is 3 months. Again we are using months as the benchmark. So, it is 6 months by 3 months, that works out to 2 contracts. Let us see how the hedge operates. The futures quotes are 89.2 and 90.3, which translate to futures prices of 973,000 and 975,750. We worked it out as in the earlier case. So, the profit per contract, now this is a long position. This is a long position. So, this is this minus this, which works out to 2750 and the profit for the futures position is 5500. Now, let us look at the interest rate. The interest rate at T equal to 0 was 11%. The interest rates on T equal to 3 when the investment was actually made is 9.6%. The maturity is 0.5 years, that is 6 months. So, the interest income for this at this rate is this much, the interest income at this rate is this much, the loss in interest income is 7,000 rupees. You make a loss in interest income of 7,000 rupees, you make a profit on the futures position of 5,500 rupees. So, in effect the difference is 1,500 rupees. But there is a catch. The catch is at t equal to 3, this is 0, this is t equal to 3, I make the investment. I liquidate the futures at this point, and this is t equal to 9 when I liquidate my investment. Now, the futures position is liquidated at t equal to 3. When the futures position is liquidated at t equal to 3, the profit is realized at t equal to 3. So, I get the futures profit, I get this amount at t equal to 3. When does this loss occur? This loss in see, the default assumption is that interest is paid post facto, that is interest is paid at the interest of the interest period. That is the general practice. So, that being the case, this loss of 7,000 rupees will occur at t equal to 9, will occur at t equal to 9. This loss is going to occur at t equal to 9. The profit has occurred because of lifting the hedge at t equal to 3. Therefore, the matching of these two is not consistent in terms of time. So, either you bring it back to this or you bring it forward to this. In other words, either you take the present value of this and compare it with this, or you take the future value of this and compare it with this to work out the actual hedge effectiveness. Thank you.